Doesn't look like I'm winning.
Oh, okay. No worries, it's fine. I'm just going to read out a brief um bio on you. I think people have joined the session. Good afternoon, everyone. So, Pearl, you're ready, yes? It's okay to read a short bio on you, yes? Sorry.
Yes.
Okay. So we have Pearl here today. She's an experienced and all-rounded finance professional, currently a finance consultant for corporate businesses and a business coach, a mentor for small medium enterprises. She has demonstrated a strong background through work history in professional services, FCMGs, facility management, and state-owned industries. Skilled in project finance, accounting, tax, and business strategy. She's a dynamic professional, graduated from SAICA, and also in the Oh, I see you now. Hi, Pearl. Process of registering with CIMA to become a CGMA. I think you should tell us what the full meanings of all of that. But yes, it's good to have you with us today. And yeah, I'll hand over the platform to you to, you know, for the next hour. Thank you.
All right. Sorry, I was just responding to you and I was on mute, but it's fine. Good
Oh,
morning, everyone. I think you've given out a very good introduction. So, if I had to add, so I am my name is Pelmore. I'm a chartered accountant from South Africa. I'm registered with the South African Institute of Chartered Accountants. I also wrote my CIMA strategic level, so that then with my application and submissions will qualify me as a chartered global management accountant. I work with SMEs in South Africa mostly as a business coach, mentor, and I also do their accounting and their tax and submissions. I also do training and facilitation in the financial management space. Yeah, it's lovely to be here today.
thank you so much, Pearl. I just wanted to add quickly, if everyone can state their names and their businesses and where they are from in the comment section so that we can have an idea of who's here. Yes, that would be lovely. So yeah, back to you, Pearl. Thank you.
All right, thank you, Deborah. I think so. We ready to kick off? Can I share my presentation?
Yes, you can.
Okay, let's do that. Okay, you can let me know as soon as you can see my screen. Can you see my screen?
No, we can't actually.
Okay, let me try again. Because this minute I share, then I'd lose my screen. So let me try again. Present share screen. You just try entire screen. Um, can you see the screen now?
Yes, it's coming up. Yes, we can see your screen.
All
Thanks.
right, perfect. Then I think if you are happy, I just want the focus to be on the content itself, then and on me. I think everyone has seen my face, so I'm just going to go back and switch off my camera so that we can focus on the screen. Okay, I'm going to share the screen again. All right. Right. So you can still see my screen now.
Yes, we can.
All right. So, welcome everyone. I would have liked to know who's on the call, but I think we are going to have an interactive session. So what I will then ask is I will ask a question, and if you are going to answer the question, then please just let me know and then say your name so that I can also know who you are on the call, and we can interact better at the session. This is meant to be an interactive session, not just a presentation from my side. Um, yeah, so I'll just move over to the next screen, to the next slide. Sorry. Um, I'm not sure why I'm having challenges, but anyway. So now we're rolling. Okay, so I've just prepared a little bit about ourselves. So the name of the company is Moran Associates. We were founded in 2016 and we started operating in 2020. We're a team of chartered accountants. The founding director and CEO is myself. We are a level 100% Black female owned company registered in South Africa. We have a main partnership with another chartered accounting firm that does accounting, tax, and automation. And our current anchor client is the South African Institute of Chartered Accountants with their enterprise development program and the Hope Factory. And we've been working with them since 2021 to develop small to medium enterprises in South Africa. Our current business model is owner coaching. So we coach the owner and of the business, and we also provide freelance accountants for back office accounting solutions. So that includes the accounting and the tax element of the SME. And then also we run a graduate development program internally where we take unemployed graduates in South Africa and we develop them for a period of 12 months within our organization. We Our target market is registered SMEs in Africa, so at incubation phase. So whether you're at startup or you're at growth phase, we work with you. And our approach is we design unique business diagnostic assessments for the SMEs so that we can tailor the coaching approach. Like I mentioned earlier, we do accounting, tax, and financial management consulting. We also do group SME training and development. We do funding readiness assessments, and previously mentioned the coaching and the accounting and tax support services. Okay, so I'm just going to jump straight into it. I think I will start by asking a my first question. Just if anyone can tell me what they think accounting for startups is, or just accounting as a concept. What is accounting? If anyone, I'm not sure, Deborah, if the attendees have a capability of unmuting and just sharing the answer.
Um, Please, you can give your answers in the comment section. So this platform, you can't it's just you and I that can see and speak to each other, but everyone else has to communicate um through the comment section or on the link that I have just put up on the comments if you want to speak. But you can also um, send your responses on the comment section.
Okay, so yeah, I have a little bit of a challenge because I'm using one screen, so I'm not able to see the comments because I'm in presentation mode. So I won't be able
Okay,
to.
okay. I could read out responses for you if there are any. I can see. I can
Okay,
see. Yeah, I haven't. There are no responses yet.
okay. So I'll just
Okay,
jump
so
straight.
Peter has said. Peter says accounting is a process of recording financial transactions pertaining to a business.
Okay, that's 100% spot on. Thank you, Peter. So I'll just jump straight into it. So there is a definition of what accounting is, but I think simplistically, for startups, if I had to speak to someone who is not in business yet or someone who does has no idea what accounting is, I think the simplistic definition then would be the process of keeping track of all your financial transactions within a business, such as money going in and money coming out. So that is just a simplistic definition of what accounting is. And the goal of accounting is to record and report. I think that's very important to just grasp. You need to record so that you can report your financial transactions, your financial performance, and your cash flows. And the accounting is governed by the International Financial Reporting Standards. So the way that the accounting is done then is very much guided by the legislation, which is the International Financial Reporting Standards. Okay, so there's different types of accounting. There is what we call financial accounting, there is management accounting, and then there's also tax accounting. Okay, so what everyone might be familiar with is the financial accounting, which is mainly the process of generation of annual financial statements to show how the company performed. And that is split into three main statements. I've just used the old names because they resonate a lot within the startup community. There are IFRS names. For example, the balance sheet is now called the statement of financial position. The income statement is now called the statement of comprehensive income, and the cash flow statement is now called statement of cash flows. There is also another statement which is called statement of changes in equity. But for the purposes of periodic reporting, so such as monthly reporting, the three main and the three most important are the three that I've mentioned here. But once the company then gets to a stage where they have to prepare annual financial statements, then there are four sets, which include then the statement of changes in equity. Then most startups outsource the function to an accountant because it can get very technical when you get to annual financial reporting stages. But as I go through the presentation, I will advise in terms of the day-to-day management on what you as a business owner can actually do to make sure that firstly you have an understanding of what's happening in your company financially, and secondly the information that you provide to the accountant or that the accountant provides to you then it does not feel like it is information outside your understanding. Then what we call management accounting, that includes costing, is it's certain elements that includes budgeting, forecasting, and then financial analysis. So management accounting is used for decision making. So the financial accounting is when you are preparing the information, but then once the information is prepared, what are you going to use the information for as a business owner in order to be able to make the decisions? So that's when we get into management accounting. So one form is financial analysis. So even though you have an external accountant in certain instances, as a business owner, you need to be able to read and understand that information. So that's what we call financial analysis. You need to be able to understand how your business is performing on a periodic basis. So whether on a month to month or on a year to year, that is what financial analysis is used for. Because as a business owner, if you have to speak to potential investors, you need to be able to say, within my company, my revenue or my income has grown by 50% from 2020 to 2023. And that information then comes from the information that you receive from your accountant, and then as you analyze the information. The budgeting and the forecasting, I will give some detail on it on my slide later. then we can better understand what is the difference then between budgeting and forecasting, because in most cases it is always seen as it is the same thing. If I forecast or if I budget, it's the same thing. So we'll get into the detail around that. And then tax accounting is then the rules that apply when you now have your financial accounting information and now you have to use that information for tax purposes. So then the accounting rules, they guide in terms of how you can minimize a company's tax liability legally. So there are ways that you can actually work out on those numbers to minimize the tax liability for the company. So it's also for strategic decision making. So I'll just pause there, Deborah, and see if there are any questions at this point.
Okay, thank you, Pearl. If there are any questions, please use the link or the comment section um, to share. Thank you.
Okay,
And
thank
Pearl,
you.
I'll let you know if there are any that comes up.
Okay, all right, so that's fine. So I'll move over then to the next slide. So accounting has two bases. There is what we call the cash basis and the accrual basis. So earlier I did mention that the accounting rules are guided by the International Financial Reporting Standards, which is IFRS or IFRS. So that IFRS rules are very much aligned to the tax legislation rules. And that's why we always say accounting is on accrual basis rather than it is on cash basis. So cash basis is the exchange of cash. So it's basically your cash book, money in and money out. Then based on that, you can be able to say as a business owner, this is what I used the money for, and allocate to certain expenditure. Or if it's income, then you can be able to say, okay, this is my revenue or turnover because it's the money I received from my products or services. And then the other income that my business generates outside my main core business. And then the expenditure, you can be able to say, okay, within a particular month, I was able to spend 300 rand on electricity, 200 rand on water, and so forth, using your cash book. So that is what we call the cash basis. So in most instances for startups, that is always the starting point to say, okay, even though the rules want us to apply the accrual basis of accounting, as a business owner on a daily or on a weekly or on a monthly basis, depending on the number and the frequency of transactions, as you prepare your cash book or as you analyze your bank statements, you need to be able to give an explanation of what that expense pertains to or is for. That's number one, especially if you are operating as a startup in an environment where you haven't started working with invoicing. So your invoicing is not up to scratch. And when I say invoicing, I don't mean you invoicing your clients, because that is always the first point of business. As you do business, you need to be invoicing your clients. I'm talking now the invoicing that is coming to you for the services that you go and acquire from external, whether from external creditors or if you are buying cash. So then you haven't gotten to the norm of saying, okay, for every tap that I use the card for, or for every debit order, for every EFT transaction, I will have supporting information. I will have the invoice that supports that, and the invoice will have the invoice date. So if you are still operating on a cash basis, then it's important then to say, all right, I can see all my transactions for October 2023. I am able to say what each transaction is for, and then I can use that as my cash book to say this is the money that I received versus the money that I'm spending, plus minus, am I on a net loss or am I at a net profit? That is the cash basis. Where the accrual basis of accounting then comes in, it then comes in to say, but the money accrued to you before you actually received the money. So when you invoice your client already owes you. The fact that they don't pay you today and it's not in your bank statement doesn't necessarily mean that the money does not belong to you. And that's how the tax legislation works, because tax says, I want my money now. So if you are VAT registered, so if you are registered for VAT in South Africa, or if you are registered for income tax, which is the general tax across, the taxman or the tax woman is saying, I want my money now. So if you are going to go and sell 10 bottles today, whether the people pay you today or they pay you in 14 days or in 30 days, I want my money today. So that's when then the accrual basis comes in. So because of those rules, then the accounting, between the accounting and the tax, then the accountant then needs to adhere to those rules. But that normally works very well, one, if you have a system, an accounting system, or number two, if you have accustomed yourself to keeping every invoice, because invoice date then becomes very, very key to say, when did you actually sell this thing, whether you received the money or not. And also, when did you go and procure a service or goods, which is your cost of sales. Then from there, you can actually say, okay, I know all the dates, I can put it down and then account for my expenditure and my income in that regard. Then you have reached the accrual basis stage. Um, Unfortunately, the rules as they stand today, they're saying everyone should be on accrual basis, because if the tax legislation, the tax regulator comes to your business premises today, they do not want to see bank statements for the business. They want to see the invoices. But we understand that as a startup company, there must be a starting point. So the cash basis is the starting point. And once you get used to the cash basis, then you get training or you get graduated as a business owner to then start gradually moving to the accounting basis of the accrual basis of accounting, which is why then the next section speaks about the accounting systems. So, as a startup, it is always advisable that you subscribe to an accounting system for reasons such as the one that I just mentioned now. That if you are on an accounting system, you will be invoicing from the accounting system. So, if you are selling goods or services to external parties, you will then use the system to send them the invoices. And as you generate the invoice from the system, then the system will record that as a transaction date. And then it will only match out the cash flow when it comes in. So the accounting system is very important in that regard. And then, secondly, it also teaches discipline in terms of procurement. So if you're going to procure something for your business or if you're going to pay an expenditure, on the system, you need to tell the system, or you need to raise a purchase order, what we refer to as a PO, and say, I want, which is the intention to buy. I want to buy 100 red pens. Then you tell the system, and then you say, based on the quotation that I've received from this service provider, the amount is so much. Once you receive the invoice then from that service provider, then on the system, you will settle the invoice against that PO or intention to purchase. That is when the transaction then is recorded, not when you go and you pay. Because in certain instances, as a startup, we understand everything is cash. You buy cash. But as you graduate and you grow as a business, then you start opening 30-day accounts with service providers. I am a I work in construction. That is my business. I build houses. So if I need materials to build, I go to builders, I get the material, they give me an invoice today, but I will only pay builders in 30 days because I have a 30-day account. So as you grow, then those are the type of things, a type of business transactions you're going to enter into. So it's very important then to invest in a system. So there's three main systems that are very popular within the startup culture. Um, the first one is Zero System, highly autonomous, very digital savvy. It has a lot of functionality. It includes the payroll within the accounting. So the accounting and the payroll is in the same system. You are able to generate management accounts and annual financial statements from the system. So that one is always regarded as superior. But what we normally say, if you've never worked on a system, zero can become very intimidating and very complicated. So we normally advise startups to start with Sage or with QuickBooks, because those are have very basic principles. And if you want to learn to use a system, that is a very good starting point. You can start from there, get accustomed to a system, get accustomed to the ways of working on the system. And once you have mastered that, then you can graduate into the zero system. Unless you feel I want an all in one system, then you go straight for zero. The pricing also shows zero is the highest priced, and then the other ones, yes, they are they can get a little bit steep, but they're not bad. I think the subscription for Sage at this moment, in South Africa, we pay about 3,000 rand, per 3,000 rand per annum for this to use the Sage accounting functionality, and there's about 3,900 to 4,000 if you're using the accounting and the payroll. But for your business, it is an investment, because that is a system that you're investing to use for your business. And then the success then of your startup is based on that, balancing your books, um, your budget management strategies, which we're still going to talk about, and then your financial strategies. What do you plan to do as a startup? In the next 5 years, do you have a view, whether documented or not, of how your business is going to perform? Because the first step, if the answer is yes, then the first step would be to say, then document it. Because you'll see as we go later with it in the presentation, then you'll start seeing why it is important then to have these financial strategies as a startup, right? And if you invest in ineffective accounting practices and sound financial management at this stage, you will then start seeing the results as your business grows. Because if you only wake up and start thinking about these principles and these concepts when your business is already within the higher mark of SME, so you're medium sized and you're going into generic status now, as now you're going to be a corporate business, it's going to be very difficult to then start adopting all of these when you are not accustomed to it from a point where you were a startup. All right, I'll just pause there for a bit, and I'll check if there is any questions, Deborah.
Yes, so Fred asked, are accrual cash or invoices taxed even if you are yet to be paid? And another question is, are these accounting systems free for use?
Okay, I think the second question I already answered later on in the presentation when I was speaking. No, there is a charge for the accounting systems, but like I say, it is an investment for your business. So if you invest 3,000 rand per annum on your business to have an accounting system, that is a very good investment for your business, right? At this stage, because once you start transacting on the bank for your business, it is the time to invest on an accounting system is today. If you haven't started transacting, then maybe yes, you can delay it. But once you start transacting on the bank, because the disadvantage is if you're going to transact for 5 years outside a system, now 5 years later, you decide, I want a system. You cannot just disregard the other 5 years. You need to then have a starting point, opening balances on the system, which then means you will have to capture back at least 2 years into the system. So that's additional work. So it's always better to invest in a system as you are starting out so that you don't have to do any backlog work that was off the system. And then the other question that came to say this accrual basis and cash basis, does the taxman then tax you when you invoice and not when you get the money? The answer is yes. The correct way of doing your taxes is to pay the tax man or the tax woman when you actually invoice the client. Um, and also, but once you go onto accrual basis of accounting, you just need to be careful. You cannot be on accrual basis for only the invoices that go to the client, so for your income. You also need to be on accrual basis of accounting for the monies that you're also paying out to your creditors or to your service providers. So it needs to match. So your ins and your outs need to be on accrual basis for you to go on accrual basis. If you haven't adopted accrual basis of accounting and you're still on cash basis, same principle applies. Whatever you invoice out to the client, you will only pay taxes when you get the money, because for what you pay out, you are actually then claiming back those taxes from the taxman when you pay out. So the timing always needs to be matched. But I have to emphasize, the correct way of doing it is the accrual basis of accounting. Start practicing um, the discipline of the management of your cash basis. Because if you at a stage where you understand your cash basis so well, and you know what money is going out and what money is coming in, and you can account for each and every transaction on the bank statement, then you are ready to say, I can move on to accrual basis of accounting. It's very, very difficult. If you are on cash basis internally as a business, and you have an external accountant, there is a way of conversion as an accountant to change your books. So, this is what we do. We get bank statements from our clients. They do the allocations of the ins and outs of on the bank statement, and then we take that information and then we say, do you have invoices to support this? Then they say, okay, we have 50%, we have 60%. But there is an accounting way, which is the correct way to convert that as an accountant into accrual basis. Because unfortunately, as an external service provider, I have to adhere to IFRS. I have to adhere to the tax rules. So I have to report from all my clients on accrual basis of accounting. So that those are the two answers that I have. And if there are no any other questions at this point, then I will move on to the next slide.
Yes, please. Thank you.
Okay. So what are the benefits of accounting? I mean, I just want to run my business. Can you just leave me in peace? I don't want to do accounting. I'm just starting out and I'm not even making R1 million per annum. Why do I need to do this accounting? Okay. So the benefits of doing accounting is, firstly, as a business owner, at any point, you need to know where your business stands. If somebody wakes you up at 2 o'clock in the morning and says, what is your revenue for last year? You need to know, because by so doing, you can actually make decisions for your business. You cannot go and decide to employ an extra person if you do not know that your business can afford it. And there is no way of knowing that your business can afford it if you do not have an accountant, if you don't have accounting records. How would you know? Just because at the end of the month you see, after paying salaries, you still have some money left, doesn't mean that your business is profitable. It just means that there's a cash flow delay, or there's a cash flow upfront in certain periods. And you would also see, as a business owner, if you are still at that point where you judge your business performance by how much is left in the bank account every month, you will see the inconsistencies that will show you that it does not mean that your business is profitable if you have money at the end of the month. And also, it does not mean that your business is loss making if you do not have money after paying for everything, or you need more money at the end of the month. It just means that there is a timing difference between when you invoice and when you get the money and when you pay your expenditure. And I'll explain that when I go into the next slide about cash flow management, because cash flow management is an entirely separate concept to say, how do you manage your cash flow? Because cash flow is not profit. Profit is I am making so much money and I'm paying so much expenditure. And also, over and above those expenditures that I'm paying, I still have other obligations. For example, I need to pay taxes. Whether I'm paying taxes or not, I need to account for the fact that if I make 100,000 and my tax percentage for my country is 30%, that 30% in that money that I make still need to be paid over to the tax regulator. Whether I'm paying it now or I'm not paying it now, I need to show it. So that is when then cash flow does not become profit. The other example that I can give is you have a factory and you have a machine, or you just have one machine because you're starting out. You bought the machine last year. The machine is still operating and is making you money, but the machine is depreciating. So, how would you know that you can use the machine for 5 years if you are not accounting for the fact that the machine is depreciating every year? So that also forms part of your profitability, because what the income statement, as we refer to, should be able to reflect is to say, yes, I'm making R1 million a month from my clients, and I'm paying, after paying all my expenditures, I'm left with 200,000. But then you have to freeze and say, okay, hold on. Firstly, what about the tax? Then you say, okay, deduct your 30%, but I still have um, a profit left. Then the next question comes and says, hold on, but then what about that machine that is bringing that 1 million every year? You need to show that it's depreciating. So you need to bring in the depreciation of the machine into your income statement. But that's becoming too technical. I don't want to get too technical, but it's just an example of saying, if you don't do your accounting, or if you're not paying attention to accounting, you might miss certain important elements of your business. So that's the benefit of using accounting. And then secondly, if you are a startup and you have debt, because that is a reality. Whether you owe suppliers because they give you 30-day accounts or 60-day accounts for you to be able to pay them back, or whether you have a loan from the bank, how are you going to keep track of that? Because the only thing that you'll be able to see from your bank statements is the payments that you are making to the bank. But you will not be able at any point to then plan and say, based on my statement, this is my balance. And that balance still has a period of so much that needs to be paid off. And based on my profitability, am I still able to afford that? So accounting allows you to be able to do that on a frequent basis. And then lastly, it also allows you to keep track of the customers, because your customers, realistically, as you grow, you might be selling now, let's say you're selling vegetables, and people come and they buy the spinach from your garden and give you cash for now. As you grow, you're going to start then supplying retail stores. And trust me, when you supply a retail store, they're not going to give you cash when you drop off your produce. You will give them an invoice as you drop off the produce, but you will have to wait a specific period of time before they call you, they pay you. So how are you going to know that a Spar or a ShopRite or a Macro owes me so much money? So that's when then accounting becomes very important, because at a specific time, you will not have to always go through your emails to check the statements. You will have one set of accounting records that you can just open and say, okay, this one owes me so much. This one I still need to do and collect so much. Okay. And then small businesses and startup owners use this accounting information to communicate to external stakeholders. So, for example, when you do your taxes, your annual taxes for your business, one of the requirements is they want you to upload your accounting records. They want to see, if you're saying to the taxman, I'm owing you $50,000, and he looks at your numbers and says, okay, what is this based on? can I see your accounting records so that I can get comfort that you really owe me 50,000 and not 100,000? So that then becomes very important that you have accounting records. Secondly, you go to the bank and you're asking for a loan. First thing they're going to ask, they want your financial reports, because they want to see firstly how you have been performing in the past before they even ask you how are you going to pay back the money. They want to see the trend that your business has been performing, and the only way they can see that, you cannot tell them by word of mouth. You have to show it to them with your accounting records. And then lastly, your investors. If you're going to go out there and ask for investment, yes, you can put a very convincing and nice proposal, but if it doesn't have the numbers, it will not convince the investor that you will be able to then grow this business. So whether they're giving you a grant or they're giving you a loan, they still need to see the financial performance of your business. So then it becomes very important. And then I like the next one because as a startup, you start on your own most of the time. And as you grow, then you have to bring people in. So, how do you convince people that currently have stable jobs at corporates that have the skills that you need to come and work for you? It's very difficult because I don't know you. Your business is new. Why should I buy into your vision? So the financials then are also used as a way to communicate or to recruit, because as you speak at the interview, you don't show it to them, but as you speak, you can say, we would like you to come and join a company that has shown significant performance increase over the last 3 years of 30%. That information you don't make up. That information comes from your financial records. So that is when then it becomes important, because you can get the right skill set and talent that you need within your startup organization by using your financial information. And then lastly, you use it to analyze your competition. Um, you you need to look at the people that are doing the same thing as you at the same level, that have been operating for the same number of years in your industry. Those are your direct competitors. How are you going to benchmark yourself? It's easy for a listed company because you just go to the stock exchange and you check what is the share price. But for me as a startup, how do I know that my startup is successful? I need to be able to, at any point, see when my competitor at a pitch competition says my revenue is growing by 30%, I have been able to get profits of 20% every year. I need to benchmark myself against that. Okay, how much am I making? Is there something that they're doing that I'm not doing? Why am I only making 10% when they're making 20%? That also helps you to develop your business. And then lastly, investment opportunities. You know your numbers, you can go out there and look for funders. You can apply for funding, you can apply for incubation support and so forth. You put your numbers out there, you show confidence in your business. So that's when then accounting also becomes very important. Okay. Thanks, Deborah. Is there any questions at this point?
No, not at the moment. Please, if you have any questions, you can send them through on the comments. And also, if you could fill out the attendances on the screen. Thank you. Thank you so much, Pro. That was really insightful. Please send
Yeah.
questions.
Yeah, no, I'm still going. I think I have about two or three
Oh,
slides.
oh, you seem like you were. Oh, right, right, right. Carry on, please.
No, no, no. I just want to get questions as I go, because then if I get all
Okay.
the questions at the end, it's not a problem, but
All
it's
right.
nice to have
All right.
questions as I go.
All
Okay,
right.
so
Thank you.
financial records for startups, very, very important. If you're going to, so one of the things that, if you go and you register your company with the company registrar of the country, in South Africa, we call them CIPC, you actually saying, I agree that I will maintain financial records for a period of 5 years as you get allocated your name. So Mora and Associates Pty Ltd. I got that name from the registrar. I am registered. I have a company registration number. And for me to get that, I said to the registrar, I agree that I will keep financial records for 5 years. So at any point, the Companies Act is saying you need to retain these documents because you're a registered company within the country. So I agreed that I'm going to do that. But then what are these financial records that I need to maintain? So for me to be able to do your financial statements, your management accounts, these are the documents that are required. So we call them supporting information or supporting documents. These are the documents you need to maintain also for the tax registrar. Your bank statements, that is easy because most of the time you use online banking, you have a banker, a business banker, you can get your statements. Credit card statements or overdraft facility if you have one. Creditors or lenders' invoices and statements if you have any debts. Receipts, invoices to customers. If you invoice out, you need to retain those documents. Cash invoices. So if you go and you buy at a store for the business and you use either EFT or card, you need to keep that invoice. Financial statements then is what we prepare as accountants using this information. Tax returns and supporting documents. So for all the taxes that you are registered for, you need to keep all those documents. And then the last one is the assets register. If you have an asset in your business, and I know most businesses would say, I don't have an asset, I'm still small, but you have a laptop. That is your asset. You need to show that you have an asset. It gives confidence to the investor as well that you understand that for your business to show strength, you have a balance sheet. And in your balance sheet, you need to show your assets. If you're going to borrow money from the business, if you're going to borrow anyone or any organization money from the business, you need to show that there is someone who owes the business money because that shows strength of the business. If the business is able to lend someone money or to borrow someone money, then you need to show that in your financial statement. So all of these documents very very important to keep for a startup business, right? So when you are starting, what do you do? Now you might be feeling overwhelmed and you're thinking, okay, what do I do? You analyze your business transactions. That's the first thing. Take your bank statement and then start saying, okay, this transaction and that transaction is for this. If you have anyone that doesn't pay you immediately, you start creating a list. I have 5 clients, 3 of them are paying me cash, but 2 of them pay me in 14 days or in 30 days. You have a list of those. Writing of journal entries then comes after because that is accrual basis of accounting. Keep all your invoices, no matter how small. If you pass a toll gate, you ask for the receipt, you keep it. It's a business account. If you're going to an engine shop because you're traveling for business and you buy a Coke, you need to keep a receipt. So all your invoices and your receipts, very, very important for bookkeeping. Trial balance, that is what it gets prepared then on accrual basis of accounting, or if you have a system, an accounting system. Reconciling bank statements to trial balance, that is an exercise then that happens at month end that says, okay, this is my bank statement, this is my trial balance. What are the non-reconciling items? Because those non-reconciling items should then be the result of accrual basis of accounting. Tax returns, we've already spoken about the importance of that. Okay. So I'll just jump straight into finance. So we were speaking about accounting the whole time. So because I know that the concept of accounting and finance might sound exactly the same, but financial management and accounting are two separate concepts. Accounting is the process of maintaining and capturing and reporting. That is accounting. Financial management is okay, now I have the statements. Now I have annual financial statements. Now I have management accounts. What do I do with it? So that is financial management. So the first concept of financial management is cash flow management. So that's why I was saying I'm going to speak about cash flows later. So cash flow management is now you have a cash book because you take your bank statements every month. You allocate as you do your accounting, you allocate them to expenditures, income, revenue, Okay, this is other income and so forth. Now you have that cash flow statement. What then do you do, to manage your business? What do you do with it? Okay, you need to make decisions based on that information. You need to, because why are you always on overdraft at month end? You need to be able to understand, why am I in overdraft? Because I think I'm paying too many expenses, or what is happening? There are ways that you can manage your cash flow so that you are not an overdraft at month end. First one is send invoices as soon as possible. If your client is on a purchase order basis, if they send you a purchase order and you do the work, and as soon as the work is done and signed off, then you invoice. Don't wait a day later or 7 days later. Once you get the sign off, you invoice. Or if you deliver certain goods to your clients, and then you give them an invoice as at delivery. When you give the delivery note and they sign the delivery note, do not wait a day or 7 days later. Then you issue that invoice, because then that means cash flow is going to flow back to you quickly. Try and delay payment to creditors. I know that this sounds bad, but what we basically mean here is your payment term must not be shorter than your collection period. So everyone is paying you back 14 days, 30 days for your goods and services, but you buy everything cash. Obviously, you'll be in overdraft, because as soon as you get money, you pay it out. As soon as you get money, you pay it out. But for people to give you money in your business, you have to wait. So we always say your collection period from your clients should always be shorter than your payment period. So if you have an account with a service provider, because you buy from them, your materials from them, your raw materials from them, that account, if that account is 30 days, make sure that the payment terms to your clients is at least 14 days, because then that's cash flow management. Monitor your debt. um if you don't pay your debt in time, they accumulate interest, and you will have unnecessary additional interest that then will kill your cash flow. Monitor your debt. If at any point you have debt and you can see that I am unable to pay due to cash flow constraint, make the payment arrangement immediately. Because if you make the payment arrangement, it stops the additional interest and penalties and charges and so forth. Then you are managing your cash flow positively. If you have excess cash in your account at the end of the month, do not keep it lying around there just because you want to see your business account with money. There is a money market account that you can open that is linked to your business account. Transfer the money there, it accumulates interest, so then that's extra cash flow for your business. Look at your business operations frequently. Do you have excess expenses? You have expenses that the business doesn't need, or yes, the expenses were applicable at a specific point in time, but they are no longer applicable now. So yeah, I used to have 5 clients, now I have 3, but my staff complement is still 15. When I had 5 clients, I had 15 employees. Now I have 3 clients, but I still have 15 employees. Does it make sense for my business? No, it's draining your business. You need then to make those tough decisions to say, because I'm only servicing 3 clients now, I only need 9 employees. Then you take through the processes of then reducing the expenses. Inventory, you have to do your stock counts and your stock checks regularly, because if you do not, you've already paid for those raw materials that are sitting in the storeroom. They will go obsolete. You need to have a look at them regularly. You also need to assess slow moving inventory, because if your inventory is slow moving, then it means there's something wrong. There's something wrong in your business. Why are you not selling? You need to have a look at that on a regular basis, because that is cash. As you sell stock, you get cash. If it's sitting in the warehouse, you're not getting cash. So then that's cash flow management. And then the next concept on financial management is budgeting and forecasting. Okay. What is the difference between the two? What is it? So for both of them, the overall definition is similar. It estimates your financial performance on your past, your present financial conditions to plan for the future. So if I say to you, give me your financial statements for the past 2 years, I need to do a cash flow forecast. That means I am relying on your past performance to be able to help you plan for your future operations. So that's what a budget and a financial forecast is for. The difference between the two, cash flow forecast is exactly that: cash in, cash out. Budget, accrual basis of accounting. So if you had to produce financial statements today for next year, how would they look like? Yes, you haven't got the real numbers, but you can be able to use the current numbers to plan for the next 12 months. So that is a budget, right? Budget and financial focus can range between 12 months. You can have a budget focused for 12 months, all the way up to 5 years. You can even stretch it to 10 years if you can. And most of the time, when you apply for funding, the funders or the investors want to see your cash flow focused to say, okay, how do you think your business is going to perform for the next 5 years or 5 to 10 years? Then that's when this becomes very important. Templates are available either on the internet, or if you're part of an incubation program, the incubators normally have templates to do budgets and cash flow forecast. But be careful when you use the templates from the internet, because you need to use template from reliable sources, just to make sure that you are guided properly on how to do a cash flow forecast. And then lastly, if you're able to do this and you're able to translate it to lenders and investors, it provides confidence to them that you understand what is happening in your business. And they also then get the comfort that they can actually invest in your business. Okay. Lastly, which is what most startups need, funding, right? What type of funding is there for startups and what are the requirements? So most startups rely on bootstrapping. I use my pension fund money because I worked for 20 years to start my business and it will last me for the next year or two. That's bootstrapping. Or I'm still developing a concept and I need to create an MVP for me to be able to convince the investors that my product or my service is actually what is required by the market. Bootstrapping. I'm going to use my own funds. Every month my business makes profits. I take exactly those profits and I reinvest them back into the business to grow the business. Bootstrapping. Then there's traditional loans. You can go to the bank to ask for a loan. There's grants. Every country has grant programs. Then there's what we call invoice or purchase order funding. So certain funders say if you have a purchase order or an invoice commitment from a client that says, if you do this work, we will pay you, then they can finance you based on the fact that they know that you will get paid, because you have a commitment, a firm commitment from your client. And then lastly, peer-to-peer lending. So my friend or my sister also has a business that's doing well, and I go to them and I speak to them and they ask me to pitch and I pitch to them. Then they give me money, a loan, a business loan, and I don't need to convince the external funders, or I don't need to go to the bank for the loan because the interest rates are lower. That's also another type of funding. Most of the time, if you apply for funding, what do they need? They need a business plan, cash flow forecast, critical, financial statements and all management accounts. So if your financial statements are older than 6 months, the lender will probably say, where's your monthly management accounts? Because we want to see after year end, how did you perform? Are you still performing according to the trend? And then lastly, most important, tax compliance. No one is going to fund you if you are not tax compliant. So those are the main things that the funders look out for, um, if they're going to fund your business. And these elements then also form part of your pitch. If you're going to pitch, you need to have all of these support, so that when you speak, then you can get the numbers from all of these elements and all the concepts from these elements and be able to speak to a potential investor. All right. So that's me. Thank you so much. Thank you for your time. Thank you for
Thank
listening.
you. You have a question here.
Yes, I'll take
One
the questions.
question. So, from Gianni, he's asking, when you get a SARS email after your CIPC registration, does it mean you have a tax clearance and can register for it online?
Okay, so Gianni, when you go and register on CIPC, automatically you get an income tax number, right? What does that mean? That means that you already are allocated a income tax number. What you need to do is you then need to register. Yes, you can register online. So previously they wanted you to come to the branch. That was pre-COVID, because they wanted you to come and present yourself as the person that is attached to the business. Currently, you can do it online, and then when you activate the registered representative of the company online, then they ask you to send you a picture of yourself holding your ID. So that sort of replaces the physical appearance at SARS. And they also ask you to attach then the CIPC and proof of business address and whatever else they can ask. But the process has been streamlined so well, I think everything can be done online. But the fact that you are registered on CIPC and if you are trading, then that actually means you already are obligated to start accounting for your taxes. Okay.
Okay, thank you so much for that answer, Pearl. If you have any more questions, I'll just give like a minute to just share your questions, or you can join on the link. Also, please fill out the attendance form on the screen. In the meantime, thank you so much, Pearl. It was really an insightful learning about accounting and finance for startups. Um, yeah, it was really um, insightful. So
Oh,
thank you very
okay.
much.
Let me switch on my camera. I see Peter because I'm going through the chats now. I just went all the way back to the start. Bright Light, the founder of MedNet Africa. I'm joining from
Oh
Liverpool,
yeah, there's
UK.
yeah, people are introducing themselves.
Yeah,
Yeah.
big ups, Bright. Fred from Fresh Fish Ghana. Peter Nirogo from Zambia. And then Fred said, "Can I see your face?" There's my face, Fred. It's not the one that you see on the picture because that one has makeup. This one doesn't. Um, yeah. And then accounting is display. Oh, those were the answers to the
Yes,
question.
some of the answers, yeah.
Um, Trade Hunt, South Africa. Gianim Julie, nice to meet you. Hopefully, we'll meet in South Africa. Um, okay, the other questions were answered.
Yes, all
Uh,
the questions have been answered. I wanted to ask you if you could share your slide with Pascal so that we can share. Some people may want to have the slide after.
okay. Yeah, I'll speak to
That's
Pascal
okay.
about it.
Thank
Yeah.
you. Thank you very much. All right, if there are no more questions, then we can end here. Please don't forget to fill out the attendance sheet. Again, thank you so much for your time today. All
Okay.
right,
Thank you. Thank you,
thank you.
everyone, for attending. Have a lovely weekend.
You too. Bye.
Bye.